first of all, Philip, I wanted to thank you, and I want to introduce you to those to our guests that haven't met you before. You are our chief investment strategist, and also our portfolio manager for our high profile program, which we'll dig into. But more importantly, I've got to know you on a more personal level as well. And one thing that you have brought is tremendous value and insights, and that's probably why BNN has you on regularly. And I know that they have a lot of turnover in their guests, but you seem to be a regular staple, and I completely understand why. So don't be scared to ask me a question in case, right?
Yeah, perfect. I'll keep those on the ready.
Now you've had your hands full without question. What a time to join us. It's a little bit over a year now that you've been with IG. Your footprint is everywhere. You've got your hands on everything, and it's very impressive. 2022 was a very difficult year, and so we are here to talk about the strategies that you're looking at, sort of what your insights are for the future, and also maybe talk a little bit about 2022, about the things that happened that maybe we didn't see coming or you didn't see coming, because that's the way it works. But what I want to preface this is that, we're retirement planners. We build financial plans. And financial plans are really about maintaining cash flow right through your lifetime, particularly with inflation adjusted incomes and minimizing taxes and helping making sure estates flow effectively. But often what supports all of this is an investment portfolio. So it is an integral part, but it isn't the whole plan. But it does have to support the outcomes that we're projecting. Otherwise, the plan will fail naturally. And I'm sure that's a lot of the concerns that you've been hearing from people. And also, certainly, I'm assuming that this is really what most of our clients are also wondering. Are we going to be okay? And also, what are the next steps? Fair?
Absolutely.
Yeah. So is this going better than BNN, by the way?
This is, what I love these conversations because they're much less scripted. It's much more free flowing, and we can change direction as you see fit.
Yeah, no problem. So again, well, let's just dig right into it. I have a degree in economics. So the first thing I learned about economics is that they call it the inexact science. And the reason it's inexact is because you can gather all the data you want, but you can only take then hypotheses about what may happen for the future, but you can be sure that that is not exactly what's going to happen, particularly when it comes to human behavior, because that is the one variable you can't measure. And by that, how do I know? How do you know when people will decide to buy a home versus sell it? We can look at interest rates, we can look at employment, we can look at cash flows, but that still doesn't necessarily tell us when, right? So I want to preface that. So I'm giving you a bit of a leg out there. How's that? Huh?
That's perfect.
But there's no question that the economies today are incredibly sophisticated. The tools that are used today to help manage economies are significantly more dynamic than they were even if we go back to 2008 during the Great Recession. And making comparisons to the early 80s or even the 70s, to me, is almost irresponsible, simply because the data points that are available today, it is not like the past. So I'm gonna say it. I hope you agree. So with that in mind, when we enter 2022, everybody had some ideas of what may happen. So maybe you could just touch on some of the things that surprised everybody and how the outcomes turned out to be the way they were.
Yeah, I'll say, Rod, first, I agree, economics is very important, really, and I'm saying this to my son who's just started university. It's like the one thing take away from economics is supply and demand, because that really does drive everything. It makes the markets make sense. It makes the global economy make sense. When we came into 2022, and I mentioned supply and demand because that had a lot to do with our thoughts on 2022. We were coming out of the COVID lockdowns and the rapid reopen in 2021, where demand was strong and supply was tight. So that was going to help drive inflation. But also we had the third component to that supply demand curve, which is how much money's out there. And so we saw a massive flood of money come into the market late 2021. And that was going to drive some of that inflation. So in 2022, we started the year thinking inflation was going to be higher than people expected. Interest rates were going to start going up, and the market would be okay. We thought, okay, I'll be full out there saying we thought we would see a positive market, but it would be an underwhelming return because valuation was rather high. And the way we measure, the prices we were paying for stocks in the beginning of last year was quite high. I would say, we had the general themes, right? Perhaps being generous on our views. What we missed and what everyone missed was the magnitude of the moves. So yes, inflation was higher. Actually, inflation was the only thing that we probably got right, where we said, look, inflation is going to trend, 8, close to 9%. Got that. But it was the rate that the Bank of Canada and the Federal Reserve in the United States and other central banks were going to raise rates that surprised everyone. We all knew the Bank of Canada was going to raise rates. We didn't think, no one thought, to just over 4% by the end of the year. I mean, that was the surprise. We knew the markets would be underwhelming, but then we got a bear market, so it was the magnitude of the move that really surprised us. But also all else, was somewhat as expected. You're going to get slower economic growth coming out of a big boom that we saw, and that's what we're seeing. But it really was that rates are going up. They went up a lot further than we thought. Markets were going to be below average. They were well below average.
Yeah, no question about it. And so, the leading question always will be, based upon media, of course, because that is really the information that we're getting today on social media and media. I'll let you talk about it. But, when we're making prognostications about the future, there are things that are consistent. Things like, and you mentioned, corporate earnings is a real great example. And I believe that one of the great things about coming into this environment that is different than the past is that when the pandemic hit, the great corporations of the world went into stress mode. And they did a lot of things to make sure that their future was going to be okay. So I'll let you again talk about it, but coming into this environment, many of these companies may be in okay shape. I'd like to hear your opinion.
Absolutely. I think companies are in fantastic shape. They've managed their supply chains fairly well. They've managed their labor force fairly well. They're managing inflation where they can. They're absorbing some of it and passing some of it on relatively easily to the consumer. With that said, though, Rod, we also know that we are heading into a slower economic growth period and perhaps a recession later this year. Everyone knows that, though. That doesn't come as a surprise to anyone. Yeah. We've been talking about it for 6 months, and some people have been talking about it for longer than that. So while companies are in a great position and they're going to manage through it fairly well, we shouldn't think that the stock market's just going to rip ahead. Earnings and corporate profits, while still positive, are likely to be lower in 2023 than they were in 2022, which is normal when you go through the economic cycle. And when the economy slows down, guess what? Sales slow down. We don't go out and maybe we have fewer Amazon packages coming to our doorstep. Maybe we're not going out for dinner quite as often. Everyone's tightening the belt, and things moderate. That's what we should expect in 2023. But that doesn't mean that the markets will be bad, because the markets, being a forward-looking mechanism, we were pricing this in or factoring it into the valuation in stocks last year, right? So I would say that the markets are ahead of the economic reality, saying, hey, we see slowdown coming. All right, let's, maybe we shouldn't be bidding up stocks as much as they appeared, maybe they were worth in 2021, because the growth environment's changed. So while we're heading into a slower economic growth period, I think the market actually, as we've seen just in the first 2 weeks of this year, is poised to do better, much better than last year in terms of, I think we'll see positive returns, but better overall.
Yeah, and I'm glad you touched on that too, because that's a really difficult thing for everybody to understand, is that markets are forward looking, and by that they price in what they see coming in the future. And I'd like you to dig down a little bit more into that if you can.
Certainly. Well, we look at so much data out there, and I'll say it starts with this. It starts with really orders, I guess, right? If you think about your Target, your Walmart, your Canadian Tire, they start their Christmas buying well before Christmas. They start their Christmas buying early in the summertime, so that they have all the inventory come September and October to stock the shelves. Now we can see what those orders look like. And so if the retailer isn't quite as confident because they're seeing the consumer trend ease, well, they're going to ease up on their buying. And so we already know what Christmas sales are going to be like by summertime. And so the market then, because the market is looking for this information on an ongoing basis, you can start to price this in. And when we say price it in, you perhaps don't pay as much for Amazon stock. And so the price starts to come down, reflecting what we know about orders coming in 6 or 9 or 12 months time. So there's all these indicators that we can look at. It's shipping, container shipping costs, because that's done well in advance. And so when you see that coming down, there's less demand for shipping, which means there's less demand to move goods, which means there are few orders coming in, which means sales are going to be down. There's a whole chain of events that occur, and that is what gets recognized by the market before it shows up in the raw economic data. And that's why when with economics not being exact science, economics is always backward looking. We're always looking at the inflation rate over the last 12 months, whereas the market is saying, yes, but where are we headed in the next 12? It's the Walter Gretzky quote, which is, hey, Wayne, pay attention to where the puck is going, not where it's been.
Yeah, great analogies, Philip, because I think that's inherently what people feel. People feel that, first of all, there's a disconnect because markets are falling, but economic data doesn't say it's bad yet, right? But then the reverse happens, which clients haven't really seen yet, of course, is that the economic data may get reported to be much worse, yet markets are recovering. But it is, in fact, because of that forward-looking mechanism. Again, there's no surprise that the economies are going to slow. Every central bank in the Western world has said we're going to slow the economy, so they're going to get it right, so they will slow it. And again, markets will anticipate that. And here's the problem with timing, isn't it? Because if people are waiting for news to get better, they've missed a large part of the recovery.
Exactly. Yeah, and we see this time and time again where investors react to the headline, and the headline again is often what has happened over the last 6 weeks or whatever it might be, that doesn't factor in where we're moving. And so just as an example, if we look at, I follow what investors are doing in terms of money flows. Are they buying stocks or are they selling stocks? We saw more selling pressure between the months of like May and November last year than we'd seen in a number of years. And what happened during the months of May and November, we would argue that the market found a bottom. We had a low in June and then retested that low in October. Since then, we're up almost 10%. Actually, in fact, with international equities, we're up almost 15%. So, yeah, you sit there and say, but we hear that we're going into a recession. How are the markets moving higher? Well, we're already past the recession. We're already thinking about the recovery. And so this is where investors need to put aside some of the headline risk. And I think the best approach is just be consistent. We've done work where, we've looked at what if, Rod, I had the worst timing in the world and I made my RSP contribution at the peak of the market every single year. I buy at the high, every single year. And in some years, that means the market can fall like 20, 30, 40% from that high. Versus what if I have the best timing for that RSP contribution and buy at the low every single year? Well, the long-term difference in performance is about 1%, right? So it doesn't, sitting there saying, I'm not going to buy because I'm worried about a drop is going to miss the opportunity that you can never perfectly time.
Warren Buffett, and I've said this before, but Warren Buffett had he's a quote machine, so you can grab always a few of his, but you hit the nail on the head there. One of his great quotes, in my opinion, is he said, when it comes to investing, he said, the strongest organ in your body isn't your brain, it's your stomach. Mm-hmm.
Yeah, absolutely. And in fact, some of my colleagues and I remember in this was early 2009. And remember, that recession was awful. And that was a near global financial collapse. We don't have anything like that today, right? But the reason in 2009, just as things, would seem like they couldn't get much worse, one of my colleagues said, it's the best time to invest when it makes you sick to your stomach to think about it. And that's ultimately the truth. Like if it makes you nauseous when you think about putting money to work in the markets, it's usually the best time. When it's an easy decision, for example, when all of my friends that know what I do for a living were bragging to me about what they were buying in the back half of 2021, you know that we're near the top of the market.
Yeah. Did it start with a B and end with an oin by chance?
Well, that was one of it. The other, but there were many other ones. One started with an S and ended with Opify.
Yeah.
So,
Yeah. Yeah. By the way, speaking of Shopify, tell me what was the performance of Shopify last year?
oh, it was down about 75 to 80%.
Yeah.
And it contributed about half of the losses of the TSX for the year, just that one stock alone.
Yeah.
And it's funny, it's a great company. I think it's a company that is doing some really neat things. And financially, they don't have an issue. What happened was, it's not their fault, but the market got caught up in euphoria and
Yeah.
got the price wrong. And
Overpriced. Yeah.
yeah,
Yeah, that happens. So, so we're talking a little bit more macro at the moment, of course, and one of the things that I'm very grateful for is that as a company, and particularly over the last 15 years, we very much have always focused on proper diversification. By that, I don't mean just different types of assets, but I mean also global diversification. And today as an investment strategist and as the portfolio manager for iProfile, I'm going to give you an opportunity to talk a little bit about iProfile, sort of some of the shifts that you have made and why, and also some of the things that are maybe coming up with the iProfile program that you and I know that you're allowed to talk about, that are really exciting.
certainly. Well, let me start with the program itself. It's a platform that has multi layers of oversight and I would say different levers to try and contribute or add to performance. It starts with just the broad asset allocation. So as you said, we want to diversify. So we built a platform that has allocations to US stocks, US bonds, Canadian stocks, international stocks, real property, so real estate, private equity, private debt. So some very, very unique asset classes, including ETFs are in there as well. And then our program managers, our product managers go out and seek to find the best or the top portfolio managers, those that have consistently proven performance using a kind of a standardized methodology to pick US stocks, right? So I don't buy the individual stocks in the portfolios. We have other experts that do that on our behalf, and they're all with other companies, whether it be Fidelity, Beutel Goodman, T. Rowe Price in the United States, Wellington, and so on. Then I come in, and my job is then to manage the asset allocation. So I'll put it this way: given the different layers of oversight, we hire a U.S. equity manager to find what they believe to be the best opportunities within the U.S. equity environment or universe. My job then is to say, yes, I'm not going to question what you're doing, but I actually think the fundamentals are better in Europe, for example, than the United States for various reasons that I look at from a macro perspective to say,
Is that a true statement?
yes, yeah, absolutely.
Yeah.
Absolutely. Right now we're seeing that. We've been seeing that for a while. And so then I will dial back the US equity weight and add to Europe or add to the emerging markets or add to bonds. And so all these different layers of oversight, what we want to achieve is consistent outperformance. Everyone is doing their part to make the best cake that we absolutely can. We go out and we find the best flour mill, the best sugar mill, and I'm kind of the head chef saying, yeah, stir that faster. That's my job. So now I'll tell you what we've been doing over the course of the last year is that we started 2022 underweight bonds because we knew interest rates are going up. Now, underweight doesn't mean zero bonds, right? So we can't, because of what we want to do is stay within risk parameters for our clients. We can't be zero bonds or zero equity. But we were underweight bonds and it was the right thing to do. Equities underperformed though. We transitioned over the course of the back half of the year to increase that bond weight, to neutral because bonds are paying us a coupon again. With interest rates being between 4 and 9%, bonds are attractive. So we added back to bonds. We reduced our US equity weight over the last 2 quarters of the year to add a little bit to Canada, but more to international stocks and more to emerging market stocks. And here's where I'm very happy to say that all of these shifts in the portfolio have been adding value. Bonds have had a better fourth quarter and start to the year. US equities have done okay, but European equities have outperformed by 10% since the end of October. Emerging market equities by about 15% since the end of October. And Canadian equities have done a little bit better as well. So all these little moves that we've been making, in addition to what the underlying managers are doing by trying to buy the better US equities, have all been adding value. So performance has been much better in these portfolios than what the general market provided.
Yeah, that's absolutely right, because that's something that we track very closely, of course, is how we're doing against not just competitors, but also how we're doing against benchmarks. And congratulations and great calls. I think that the reason I brought that up is because I know it's going to be surprising for many people, because we get our news feeds from the US and Canada. So we forget that there's a rest of the world for investing. And so the natural instinct is to, like you said, is to hear, what do you mean? What do you mean Europe? Aren't they a mess?
Yeah, and so to that I say yes. Europe is a bit of a mess, but it's reflected in the price of the stocks already. And when the outcomes in Europe are better than the worst case scenario, this is when people start paying attention and saying, "Hey, I can pick up a U.S. or a European company that does the exact same thing as a U.S. company, but it's doing it with a 30% price discount. That's something I want to own." And so that is what I think is attracting investors to Europe right now. In fact, I'll say there's 5 things that are going on in Europe that are attracting the attention of investors. The first one is valuation, and that is that this area of the market, global equity market, is 30% cheaper than its U.S. counterpart, and that's a pretty significant discount.
That's significant, yeah,
very significant, and people are finally paying attention to that. The second one is a little bit more technical, and some people call this, voodoo investing. But technicals, there are enough investors out there that pay attention to technicals, and what we've seen is a breakout of this downward trend in Europe now to a new upward trend. So that I think is attracting attention. Third one is actually the war in Ukraine. That isn't having as much of an impact on the rest of Europe as we thought 10 months ago. And this is in terms of just the daily goings on of the European economy. Fourth one would be the reopening of China. Now, this might seem odd. Well, what does that have to do with Europe? Europe actually has greater trade with China than the US does. And so they stand to benefit more with a reopening in China than the US would. And the last one is energy. The potential for an energy crisis, given the sanctions against Russia for the war in Ukraine, and Russia supplying the natural gas to Europe. Well, what we've seen is that's largely gone away for a couple of reasons. One, it's been a much milder winter in Europe than average, so less demand for natural gas. And two, they've been very good. Necessity is the mother of invention, right? So, Europe has been very good at sourcing natural gas from other areas, such that European natural gas prices today are the lowest they've been since 2019. So, there's no energy crisis to speak of. All those come together for people to say Europe's a mess, but maybe it's not quite as bad as we thought. And wow, you're picking up these stocks at a huge discount.
Yeah, interesting. And I know fixed income, bonds, et cetera, is also part of that equation too, right? Yeah, and so I just wanted to let everybody know too, again, you can go into the Q&A, which is up top if you wanted to submit a question. I do have some questions that were submitted previously, and a couple will put you on a short hot seat, right? So a couple of quick questions for you, Philip. Hey, what do you think about the Canadian dollar? Where do you think we will stabilize if we do?
Okay, so I do think the Canadian dollar is still slightly undervalued right now. It's just under 75 cents US, or about 133 if you think about it the other way. Um, with the way that we look at it is relative to interest rates and oil prices. Oil prices, I think, are going to stabilize in this range of 70 to mid $70 range for the next little while. And so that would suggest that the Canadian dollar should probably be closer to about 78 cents. So I think a little bit higher from here.
Yeah, well, great. Yeah, well, you answered the second question, which was oil. So you went right into it. But here's what's interesting is that this time last year, if I recall, oil was somewhere around 120, was it not?
Just after the war, it had
Yeah,
spiked up to just over 120 and then settled
yeah,
back. Yeah.
yeah, yeah.
I would say, the course of the next year, you have to think that with the potential for a recession over the course of some point in 2023, demand for oil is going to slow down a little bit. Supply has been building a little bit, so the price is going to. I would say the price is going to stay in this range, plus or minus $10.
Okay. And if we are, well, in fact, heading into a recession, and just maybe you want to help a little bit what a definition of a recession is, and how they come perhaps in different sizes, and what you would expect in that, and also maybe some of the things that would lead to you to have those conclusions.
Certainly. So I would say, there are many definitions, but let's use the mathematical definition of a recession, which is 2 quarters of negative GDP growth, meaning 2 quarters where the economic output shrinks. Now it can shrink by a lot or by a little. My view, the team's view for Canada and the United States is that this is more of a hangover as opposed to a deep recession. And it's a hangover from the party that we had in 2021 and early 2022. So I don't think that this recession is going to be bad or long. I think it's going to be short and mild, and it potentially could be just a recession in pockets of the economy where manufacturing, we're seeing a recession, meaning manufacturing is contracting. Manufacturing output, we're producing fewer widgets, cars, whatever you want to think of now than we did a year ago. We're having an earnings recession where earnings are going to be down, not negative, but down from where they were a year ago. But are we going to see unemployment spike up? That would be typical of a recession. I think demographics are going to fight that. And that means that we have more boomers still retiring than newcomers coming into the labor force. And so there's still this demand for labor. And I think that's going to be what keeps the potential for a recession more moderate than what we've seen in let's say, well, certainly 2008, which was more of a financially driven recession, which tends to be very, very bad.
Yeah, exactly. And so from an economic point of view, like you say, probably the thing that's so difficult to measure in recessions is what you talked about, which is unemployment, right? How high will it go? And if people have less money, well, they're not working, of course, they spend less, and then it spirals through the economy. And that's a very difficult thing to measure trajectory. And I think that is what's unique about this situation is, like you said, this is not an unknown that baby boomers are going to retire. It's, it shouldn't be catching anybody by surprise that unemployment is going to remain low for a very long time, which means cash flow will still prevail. And is that probably the main reason why you see maybe more of a lighter recession as well?
Exactly. When you think about it, household balance sheets are very strong. People still have a lot of cash, and there's still a buildup of excess savings. Corporations are very strong. The banks are very healthy. And so we're not seeing any weakness in the demand for labor. And so therefore, if people are employed, this is going to be, sure, this could be a mathematical recession, where pockets of the economy are showing weakness, but the general economy, I think, will be fine.
Yeah, interesting. So now the big question, the big one, it's the one that all Canadians hang on to, property. Because, right? So, I mean, there's massive escalation in property, not just domestically, but internationally, everywhere. I mean, really, the run up that we saw in property values isn't just, in Toronto or Vancouver or Kelowna or anywhere else. It really is everywhere, right? On a relative basis. So, when you hear recession, interest rates rising, the immediate thing that happens, of course, is fear enters the ring, particularly around property. So, I'd love to hear your thoughts on that.
Sure. I have to start with the caveat that I am not a real estate expert. I've been wrong on it for so many years that I could never claim to ever be right on it. But when we look at the data, Rod, you're right. As interest rates go up, what that means is the mortgage cost is going higher. Now, the way that Canadians buy a home isn't the price of the home, it's the monthly payment. And so if that monthly payment is fixed at a certain rate, then you have to adjust the price accordingly. What we've seen is the mortgage rates have shot up in the last year significantly, and they're going to remain there through 2023. I don't think the Bank of Canada is going to cut interest rates this year. I think it's a 2024 story. And if they do, it's going to be modest, right? We're not going back down to 2 or sub 2% anytime soon. So anyone renewing a mortgage this year, it's going to cost more. And new buyers, really, now they know what they can afford on a monthly basis. Home prices need to match that. Otherwise, homes will just sit on the market. And we've seen that. So prices in across Canada are down. I think the average is about 14-15%. In Ontario, there are pockets that are down 30%. In Vancouver, I would imagine it's the same thing. But that only takes us back to maybe 2020. So it really isn't much of a drop yet. I think that as interest rates stay where they are, there's still going to be that pressure on house prices. But then there's the psychological side of it, which is that, is it a buyer's market or seller's market? Right? It's been a seller's market for so long, where people were like, we have to get in a bidding war, we have to put in a bully offer, we have to do this, that. If that sentiment now has changed, and it looks like it's starting to, then the buyers, even though maybe they can afford the price, that doesn't mean that they're going to jump in right away. They might go, well, you know what? No, I'm going to bid lower than that. I'm going to wait. I'm going to put these conditions on it. And so all of a sudden you shift to a buyer's market that can keep the price falling. I'll use the 89 through 92 analogy, where 1989 through 1992 property values in Greater Toronto area fell by 50% over a 3-year period. So and it took 10 years then to recover back to the prior high. I don't know if we're going to end up in that environment, but there's more pressure on prices today that is going to remain, I think, through this year. So we're not at the end of the price drop.
Yeah, fair enough. Yeah, well, listen, Phil, but I don't want to keep everybody too long. I'll wind it up. But is there anything? I'm obviously you're much more optimistic about 2023, without question.
I am.
Really.
Yeah,
I
am.
What would be your phrase for this year? Last year was I think it was return to normalcy or something like that, right? Would this be phew, I think the worst is over? Is that
yes, I think this, we've tossed around a couple of different analogies for it. One is this is going to be a triple B year, bumpy, boring, and below average. But the other one that I'm gravitating a little bit more towards is, hey, we just stepped off the roller coaster. We're about to step on the merry-go-round.
Nice.
And I think that's the way to think about it. It's going to be much more predictable, much more, smoother. There will still be some, ups and downs, but it's going to be smoother. And ultimately, I believe that it is going to be a better year, as we've seen it start off. I know it's only, 8 days, but it's an encouraging 8 days.
Yeah, I agree. So, well, listen, Philip, thank you very much again for your time, and for everybody that's on. If you have any questions at all, you'd like to contact me after, of course, we're open. We do have this recorded, so we will be sending it out to all of our clients, Philip. So, you're on the hook to do this now again, right?
And I'm happy to do it, Rod.
Yeah, appreciate that. Well, thank you very much, everybody. Thank you for joining us. Philip, have a wonderful rest of the day. And I know we'll touch base soon, and you'll let me know about any upcoming trips.
Absolutely. Thank you, Rod, and thank you, everyone, for joining.
All right. Thank you. Take care, everybody.